It is important for everyone to understand what negative rate bonds are and what they are telling us, because we know this next crisis, we've been told, we're going negative. In addition to that, you're probably, if you're making a deposit into a retirement plan, a pension, a 401k, passive investing, etc., chances are pretty good you're holding a lot of these negative rate bonds, which are roughly 25% of the global bond market just since 2009. You're probably holding them. The consequences of that are dire. So I want you to understand it, and that's what we're going to talk about today. Negative rate bonds, how they work, who they impact, coming up. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service gold and silver dealer specializing in custom strategies to help you survive and thrive through the reset that has already begun. And today, I need to help you understand bonds and negative rate bonds. So I'm going to start with the pen, and this is when the bond is issued. It has a coupon when it's issued. This is interest rates, this is principal value. So when rates go down, even when they go negative, you can see what happens to the principal of that bond. It goes up. Conversely, when rates go up, you can also see what happens to the principal of that bond. It goes down. So what happens when we have negative rates? Let me show you what that looks like. Okay, now first of all, I'm going to use this that just came out today, July 31st. Chicago PMI, which is the manufacturing index, was down a whole lot more than they expected it to be. And what that indicates is a slowing economy. And what does a slowing economy indicate? Indicates that maybe borderline corporations are going to have trouble paying their debts because they're going to earn less money. So, what was the spot gold response to that? Well, it went up. But what happened with gold? Because gold is primarily a monetary instrument. Silver and copper declined because they are primarily, silver straddles both worlds, but they are primarily industrial metals, so it makes sense with a slowing economy. The Dow, however, went up at that moment, and that's just pure insanity. But let me show you how negative rates and regular bonds work. Let's just take the 10-year note for example. Now this is showing, you can see it here. Oh, let me grab that. You can see here where it says 102.8594. That's actually the price that you'd have to pay for the bond at this moment in time. So here's $1,028 because you move the decimal point over, and 60 cents. That's how much you have to pay for that bond. If you hold it to maturity, that's what you get back. Keeping in mind that the U.S. is one of the very, very few countries that still, at least at this moment, have positive rates. What does it mean to have negative rates? That means that you pay a much bigger premium for that bond. There is no interest that gets paid, and presuming the bond goes to maturity, that's what you get back. So when you pay this big a premium, it's going to be a negative rate. Now, let me show you who exactly is buying these negative rate bonds, considering that they're like 25% of the global bonds and 40% of the global sovereign meaning government bonds that are out there. It's really crazy. But who's doing it are institutional investors. So those people that manage your money, if you make a deposit into your 401k or into an IRA or any kind of passive fund, anybody, any fund or ETF that is tied to global bond indexes. An example that comes to mind, not the only one, but one that comes to mind is AGG. So if you own that, or if you're holding that in one of your accounts, then you're holding these negative rate bonds. So millions of not just Americans, but actually people all over the world. Now, even US companies issue bonds in euros, and guess what? They too then get to participate in that negative bond universe. McDonald's happens to be one of them, and they're BBB rated, so they're borderline, except that they have so much leverage that they really should, except like they did, like the grading services did in 2008. They've been letting a lot of that slide. I've done other videos on that. So for McDonald's, as an example, the insiders and what they're doing for themselves is they're selling out, and yet 68.78 institutions hold the shares of McDonald's. That means you. So whether it's Vanguard or BlackRock or any of those guys, that's who's buying the stocks that the insiders are selling, and that's also who's buying those negative rate bonds that these corporations are issuing. You are actually paying them a premium to loan them money. If you're lucky, you get back the face value of the bond. If you're not lucky, which I think is what people are going to find, you're not even going to get that. And I want you to think about whether or not you are holding this garbage in your retirement plans. And if you are, you might want to rethink what you're doing. Because we know, what can you do about it? A lot of people say, well, there's nothing I can do about it. Well, in some cases, you can't take that withdrawal, especially if you're still contributing. But that doesn't mean there's nothing you can do about it. And I'm going to remind you of the central bank, the BIZ central bank money flower, and how the largest area is physical gold. It's the only area that is widely, universally accepted, peer-to-peer, and most important, outside of the control or the issues that the central banks have. That's how you protect yourself. So, I hope that answers the questions on negative rate bonds and what bonds are. We need to know this because we're all impacted by it. Any money that you have in there, I just did a piece on how they can take savings accounts deeply negative. It's coming, and it's not long off. So please remember, financial shields are made of physical gold and physical silver, not paper or promises or contracts that you didn't read and you didn't write. So protect yourself. Please be safe out there. Bye-bye.